Okay, good morning, everybody. Today is March 18th, and it seems as though there was a lot of people drinking on St. Patty's Day, especially over at the Federal Reserve. As we all know, the Federal Reserve, Powell made some comments yesterday. I did comment on him. I don't agree with what he's doing. I haven't agreed with what he's doing for some time. I do think that the Federal Reserve is creating a lot of long-term problems, not just in the recent cycle, but it has historically created a lot of problems for this country. You don't believe me? Look at the balance sheet of this country over the past 20 years and how much it has literally fallen apart as a result of horrible, Fed policy and so forth. So let's take a look at it. Yesterday, Powell said he is going to try and create inflation. This isn't new. He's been saying he's going to target 2% inflation, and he's going to keep pushing for 2% inflation. And then if that doesn't work, I guess once he does get caught up on the 2% inflation, he's going to turn around and possibly let it run even hotter to make up for past years where inflation wasn't 2%. So when you are consciously running a target, an inflation target, like he is suggesting, you're basically telling the American people, I'm going to try to take away 2% of the value of everything you own if you don't do anything. So if you don't go and take risk and do things in the economy, I'm going to try to siphon 2% away each year. Now, it just so happens that Europe has undergone about a 2% currency depreciation since 2008, 2009 area. And so today, if you were someone in Europe and you wanted to move to the United States, it would cost you about 33% more to live here, which is pretty lousy if you think of it that way. Meanwhile, if you're an American and you've always wanted to live in Europe, it will cost you less to go move to Europe right now. But my understanding is Europe is a bigger basket case than even the United States. They're really trying to push this great reset over there, so it is concerning, but that's neither here nor there. So Powell's his comments yesterday about this said the economy is heating up. We think that the economy is we're going to see strong growth this year. We have all this stimulus into the system, and I'm not worried about inflation. Okay, so today a couple things. Today, the Philly Fed came out, which is a gauge of manufacturing in this country. And in particular, it looks at the amount of prices, the increase in prices paid. Well, it turns out that the Philly Fed ratio is the highest it's been in over 50 years. I think it came in at 51.8 versus an estimate of 23. Now, what are all these manufacturers in the country that are responding to this Philly Fed index saying? Well, I think 59% of them said prices are on the rise. And when we've been talking about this the past few weeks, I said labor prices are going up, productivity is going down. Okay? That's the definition of inflation, folks. If your cost of everything is going up, but the productivity is falling, then that means the price paid has to go up. And the treasuries today, the TLT, the 20-year, the 10-year broke 1.7% today. I think it was 1.75%. It spiked almost 10 basis points overnight. So from Powell saying what he said yesterday, I call him the carnival barker, and to today, interest rates have spiked 10 basis points. The 30-year treasuries are now above 2.5%. Now, to give you an idea how big of a move this is, because a lot of people are trying to say, what does that even mean, Bobby? It's 10 basis points, 1/10 of 1%. What's the big deal? Well, let me tell you what the big deal is. If you happen to be hiding out, you're scared and you're nervous and you're in bonds and you're like, okay, I want to be in treasuries. I don't know what the heck is going to happen. I know the federal government will pay me my money back. So I'm worried that the dollar is going to crash. Everybody's telling me the economy is going to crash. All this stuff, right? We keep hearing the same carnival barkers bark. Well, treasuries, the TLT, you can pull it up yourself. TLT, it's the 20-year U.S. Treasury. started the year at 157.73. So for every, if you think of it this way, for every 100 shares you had, $15,773, it's now worth $13,326. It's down 14% in a little over 2 months, 2.5 months. So bonds, which people were hiding in, worried that it's a safe place, I'll at least get my money back. You lost 14% this year so far in the 20-year bonds. And you lost more if you were in the 30-year bonds. And so, why am I telling you all this? Well, because these policies, if you don't pay attention to them and you listen to people on the internet that are just telling you things with no basis for it, other than they're just peddling fear, you can lose a lot of money really fast. And in the past 2 months, some people lost a lot of money, depending on how they were situated and structured in bonds versus other types of assets. Now, it turns out that while people on fixed incomes hiding out in bonds, maybe 30-40% of their money was in bonds, those bonds lost 14% of their value. Yet the cost of oil, okay, so there's a ticker called USO. You could pull this up. USO is a proxy for the price of oil. It's an ETF. It started the year at $33 and 1 penny. And last I checked, it was $43.82. So it's up almost 33% this year. So let me get this straight. The price of my oil, when I go to the gas pump, is up a third. The price of how much my bond portfolio is worth, if I was in 20-year bonds, is down 14%. That's pretty painful. This has only been 2.5 months, folks. Now, it just so happens the S&P is still up on the year. It's actually up pretty nicely. I think it's up about, I want to say it's up probably about 5 to 6%. And why is the S&P up when this is happening? Because there is an oil component in there. There's an energy complex component. And energy is having a big year, so that's what's dragging it up. Now, the NASDAQ, the big index, is the QQQ. That's hanging on by a thread, folks. That was up on the year. It hit almost 340. It's at 316 now. It's down 1.7% today, which I mentioned last night. And once again, I'm not giving advice to anybody. I'm just kind of sharing the logic and what you need to think about when you're doing this, if you're doing it on your own or if you're looking to find anybody to invest on your behalf. But Pam, I can't discuss specific positions, so I apologize, but there's a bunch of regulatory stuff in place, and that's why I'm saying if someone's telling you exactly what you should be buying or how you should be doing stuff, and they don't really understand your situation or understand the context of how your other portfolio is, I think you should think twice about taking that kind of advice. I really do. I think you need to either use it as a data point and make the decisions on your own, or find somebody who can help you make sense of it in the context of everything else that you have going on with your money. So that's not the point of these broadcasts. So Pam, if you've never been in the stock market before, to go into metals, it sounds as though someone's been kind of trying to scare you into things, possibly. I don't know. But that's not where I wouldn't want to start in one asset class. If I was first going into the markets, I would want to talk to somebody who can explain to me what are all my choices, and why is this one better than these other ones right now, so that you have some sort of context. You don't want to just someone's telling you about one area of the market, one thing, and then you're going into there, but you don't have an appropriate perspective on the other types of choices that you might be able to make as well. So I highly recommend it. For those of you who are thinking or looking for a really good book to understand just the basics of investing, there's a phenomenal book I read, it's funny to say it, 30 years ago, funny. I'm laughing because it's like, folks, anybody who's aging, you know what I'm talking about. Like, it's like, where the hell did the 30 years go? There's a book called One Up on Wall Street by Peter Lynch. And now some of you may or may not have heard of Peter Lynch. He's one of the best stock pickers of all time. He ran this fund that made Fidelity very wealthy and very famous. I guess what I'm saying is he was the guy that figured out how to really make money in the stock market, and the Johnson family is the one that really figured out how to make money off of him. Because the Johnson family, who owns Fidelity is a private company, is worth north of $20 billion. And this guy, Peter Lynch, was the brains behind the performance when Fidelity was just starting out in Massachusetts. Look into it yourself. You don't have to believe what I'm saying. But my assessment of the situation is he was just busy making money. These guys were running a marketing machine behind him and figured out how to really grow that business. And, great for them. But I think he might have left a little bit of money on the table. I think he should have made a lot more money, given that it was his performance that drove the growth of that firm to the trillions of dollars that it currently manages today. I think when he was there, it might have been under $1 billion or something when it first started. So think about that, thousands of fold increase. And it was really started off this guy's record. So that book is about basics of investing. It's called One Up. I'm going to type it in here so you guys can see it. One Up on Wall Street. So for those of you who, for those of you who want to do your own research and pick your own stocks and you don't want to hire a professional, I really think that this book would give you a lot of perspective and insight as to some approaches you might want to consider using. Now, granted, the world has changed quite a bit. There's a lot more technology and so forth. But the good thing is that even with the world changing as much as it has, there's some core principles that you should be aware of if you're investing. And Peter Lynch, that's his name right there, I just typed it. He did a phenomenal job of sharing his wisdom in that book, and you could probably get it from the library. He's a white-haired guy, I think, in the cover. Maybe he wasn't white. I don't know. Maybe I'm just white now, getting white, and with glasses. And he was. I guess you can refer to him as an animal, like in terms of just reading filings. And he thought his big motto was, whoever uncovers the most rocks wins. So whoever digs the most into all the companies that are available out there and tries to find where there's value and so forth is going to do great. And so anyways, Peter Lynch is the person that I highly recommend that makes it easy to digest and understand how the stock market works. Okay, so we talked about treasuries. We talked about Philly Fed. Yesterday, I was waiting for the numbers to come out. I forgot to mention it in the evening, but the building permits number came in lower than expected by the tune. These are annualized numbers, folks. So 1.68 million versus the estimate was 1.75. So there's fewer people requesting building permits, which, as we said, if interest rates are going up, it is kind of making some people nervous. The other big thing that's hurting people right now with regards to housing is, I've talked about this too. Material prices. We talked slightly about oil, but the price of lumber is up over 100% in the past year. I'm pretty sure that's accurate. Last time I checked. So there's a lot of lumber in homes, people. You think about all your walls, everything, your rafters for the roof. There's a lot of lumber in a house, and so this is one of the reasons why the price of homes across the country are going up. Why? Because if the cost of replacing that home is going up because of inflation, then the existing homes will go up in value. Now, keep in mind, this is a tricky situation because taxes also have a huge impact on the value of homes, and also certain price points, because certain price points the credit markets have shut down on. So people that are purchasing homes, for those of you out there that are in the seven-figure range, if you're buying a home that's over $1 million or more, you tend to have to be a cash buyer. because the credit markets aren't giving out loans for that. And that's a whole nother problem of sorts, because those homes, depending on how they're clustered in specific zip codes or areas of the country, you really want to be sure there's some reason why a lot of really wealthy people are going to stay in that area, or you're going to eat it. You're going to stick with that house indefinitely, because there just aren't going to be that many people that can afford the upkeep. You got to remember, you buy $1 million home, you got $1 million upkeep too. And so the price of upkeep on a home tends to be, at least 3 to 5%. So you better have about $30,000 to $50,000 per million to keep your house up properly. So you can do the math. If you have a $250,000 home, 3 to 5% of that, you should be putting aside, $7,500 to $12,000 a month for all this miscellaneous stuff that can go wrong, your water heater, your roof, etc. So a lot of people don't budget that way. I do think it's a more conservative way to do things and make sure that you don't get blindsided by expenses that arise at a time that you don't really feel like paying them. And so that's that. The number of continuing claims did spike. That came out today at 7:30. It came in at 770,000 versus an estimate of 700,000. So it's pretty bizarre. Manufacturing is picking up. The number of people filing claims is going up. I wonder if there's an incentive problem that's occurring where a lot of people don't mind getting fired right now because of the extra money they're going to get from this stimulus package. Maybe that's also what's kind of driving things down in terms of, not enough people actively going to get a job, because, if you can get paid more, or almost, you can get paid almost the equivalent of what you were making while you were working to sit at home, until I think it was August, then, why not do that? Like, I could never do that, but I think there are a lot of people that don't have a problem doing nothing and getting paid to do nothing. Unfortunately there's a generation of Bolsheviks that the corrupt school system has been training across this country that is made that much more acceptable. And that's a big problem we need to reverse if we want to really deal with the funding of issues in the future with a very productive workforce. You have to have your workforce, being productive on the younger generations coming up, or the older generations are going to experience a tremendous amount of pain with regards to the amount of cutbacks that might have to occur if there isn't enough production in business that's offsetting their retirement and so forth. So that's where we're at right now, folks. Futures are down, which isn't a shock to me. I thought they would be down today because of the Fed's comments yesterday. Treasuries, like I said, they're selling off massively. I think they're off today as much as bonds would earn in an entire year for the TLT, the 20-year. And, some of the indexes are still up with regards to the equity markets. I sound like a broken record here. I've been saying it for weeks. Given where we are in the cycle, you really should consider looking at your overall risk and take the time to make sure that you're not taking more risk than you want to be at this stage of the cycle. And talk to a professional. If you don't know what you should do, contact us at Preactive if you want to possibly talk to us about what we do. But talk to somebody. Don't chance it, and don't keep putting it off. I just want you to imagine a year ago, if when that virus initially hit, if you would have, if some people moved a little faster on some things, right? Myself included, we could always get better in investing. Maybe you would have avoided some pain, and then you would have had some powder dry to step in and buy more when things were significantly cheaper. Well, in this case, looking out over the next 3, 5, 10 years, if asset prices were to stay flat or just go grind lower, how would that make you feel with the way you're situated? And you should look at all different scenarios. Don't just focus on the positive. You have to look at things in the realm of possibilities. Things go great, things don't go so great, things just basically go do nothing, and they just go sideways for a long time. How are things for you in each of those scenarios? How does that impact your future plans? You have to think that way, because nobody knows exactly which path it's going to be. As much as we might think we know, nobody really does, because the economy is an aggregation of everybody's behavior through time, and how assets price in the future is determined on how much people's, what our activity is as a nation, as well as how we interact with the rest of the nations of the world. And, those things are going to impact what the returns are that you will generate from your investment decisions and choices. So with that, I hope everybody has a wonderful day. Good morning as well, Holly, and everybody else who's saying hi. Hope you guys have a wonderful day. And I will be on at 4:00, and we'll see how things wrap up in the markets today. Okay, have a good one. Thanks.